Welcome to the video demonstration for Chapter 1, Principles of Financial Modeling. We assume that the audience has a basic understanding of accounting and Excel. Where to start? Plan the model. Things to think about are: what is the purpose of the model? Who is the audience? How much detail is expected? How much information is available? When is the deadline? Do we need a yearly or monthly model? Structure of a model. This is a summary of the steps to follow. First of all, set up the names of the tabs in your file, the timeline, the financial statements, the operating assumptions, the financial assumptions, the analysis, the returns to investors, and the sensitivity analysis. File tabs. Set up the tabs or worksheets for the model. You can always add more tabs if necessary throughout the process. Timeline. The timeline of the model includes the number of years, and whether the model will be created annually, quarterly, monthly, or even weekly. LBO models are usually built annually, but there is no reason why they cannot be created differently. It is important to have the same timeline in all the tabs of the model. Financial statements. The financial statements can be presented on one or separate tabs. The layout is always fairly standard, but you can modify them at any stage during the model development. The profit and loss will include the account names and subtotals. Think if you will be showing the costs as negative or positive figures on the P&L. In this example we will show the costs as positive. The same applies to the balance sheet. Add the account names and subtotals. It is also important to create the interlinks between the financial statements such as retained earnings. For the cash flow statement do the same. Account names and subtotals. All the cash flow lines can be pre-calculated following the principles of sources and uses of cash. An increase in an asset account is a use of cash. An increase in a liability account is a source of cash. Do not forget the interlinks to the other financial statements. Assumptions. Broadly speaking, assumptions can be grouped in two categories. Operating assumptions relate to all the business operations regardless of how the company is capitalized. Financing assumptions relate to how the company is capitalized with either debt or equity. This distinction is particularly relevant in an LBO model since the new company will have a new capital structure. The structure of an assumption is always standard and should always have inputs, which should be clearly identified. This example has inputs with blue fonts and yellow background. Calculations and accounting balances. Horizontal model building. A model should be built horizontally. This means that every assumption should be complete with all the entries into the financial statements. For example, once you have calculated the revenue line, think of the balance sheet account that is related to revenues. This account is accounts receivable or advanced income. The account balance will always have the same structure. Opening balance. Increases, in this case revenues. Reductions, in this case cash collections, and closing balance. We can now link the relevant lines into the financial statements. Let's link the revenues first. Now scroll down to the balance sheet and link the accounts receivable. Then scroll down to the cash flow statement. The relevant calculations are already in place, so all that is left to do is to make sure that the model is balanced. This means that assets equal liabilities plus shareholders' equity. This is one of the most important checks to be performed when building a model. We can now say that this assumption is complete, because all the relevant entries into the financial statements are linked, and the model is balanced. Now you would move on to do the workings for the next assumption. Take a moment to see the relationships between the different operating accounts. Take a moment to see the relationships between the different accounts in the financing model. Other important things to consider. Once all the assumptions are completed, review the financial statements. Does the projection look reasonable? Are your debtors and creditors too high or low? Do you have any negative assets? Is your layout consistent? Make sure there aren't any circular references. Test the model. Outputs should change as expected in response to changes in inputs. Last but not least, document the model. Who has built it? Version control, and other general information. For the next chapter and to access the rest of this course, please visit pecareercenter.com.